All right. Thanks for joining us today. We are chatting about kind of the state of the real estate market. I want to just briefly chat about some of the contributing factors to kind of where we're at and how it's affecting the real estate market, some thoughts and opinions on how those could change, and subsequently how that can affect the market as we move forward. And then just give a little bit of projection forecast of what we anticipate happening in the remainder of 2026. And then we'll actually dig into some general and specific recommendations as best we can without knowing your specific situation. So hopefully this will bring you up to speed very quickly today. Bring on our host, Chase Hodgson. Sorry, I flashed over as mid cough there. How you doing, Chase?
All good, man. So good.
I seem to have
Things
a
are good.
knack for that.
Yeah. Well, I'm always messing around. I think that's the problem. I need to pay more.
Oh, maybe that's what it is. Well, and I even got a little cheat mirror, cheat camera here where I can kind of see what you're doing, but I'm usually looking at anyway, I'm trying to
Yeah.
coordinate a lot of stuff. But anyway,
Yeah.
it's all good. So, before we get into the housekeeping items, just real quick, I want to get your thought because we talked a little bit before the show here. And if I had to summarize, because I want to give the Cliff Notes version, in my opinion, I collapsed it down into two words. One was uh, confusing
Mm.
and uncertain.
Mm-hmm. That's pretty good.
Anyway, so I'm curious as we go through it, kind of what your thoughts are, and if that's kind of what we unfold as we come through it. But I think if you're in the market, you're looking around, you're listening to this episode, wondering what's going on, I think those two words, I think you'll find that those sum it up, right? Uncertainty um, and confusion. And we're going to try to help formulate some ideas around that to put your mind at ease. Is the plan for today? Sound good?
Yeah. We can do that for sure. We
Awesome.
got that.
Awesome. Well, very good. Well, I'll do a couple housekeeping items here for those of you that I haven't met yet. My name is Jerod Lee. I'm the associate broker and team lead here at My Home Connection, also known as MHC Realty. Our sponsor for today is in large part collaboration with Chase at Summit to offer up to $1,000 on 500 on the appraisal side, 500 on the inspection side at closing to help minimize your costs and instill some kind of reassurance in purchasing your home or your property. And then we've just built over the last 2 decades plus a number of tools and resources that we'd love to share with you. All the way from podcasts to bring you up to speed on different terms and thoughts and concepts, to sharing some secrets, insider secrets that we think you should be aware of. But mainly, we suggest you take advantage of the no obligation consultation because the sooner you start having that conversation, the cheaper it gets, the smoother it goes. So, just a conversation around how we can help you specifically. Feel free to reach out anytime. Other than that, yeah, the reason I came up with those kind of two defining words was that if depending on where you look in town or um, what area of the economy, there's what could appear as conflicting information, right? An example would be some people say you can get a really good deal, and other people are frustrated because they're in, multiple offer situations.
Hmm.
So just really strange behavior.
Yeah. Yeah. The market's very interesting right now for sure. In our valley, and I'm in the I'm working like 16, 17 different states, and it's pretty similar, throughout the country. So, especially the states where we're seeing that big population increase.
Mm.
It's affecting affordability. It's affecting, and so those starter homes like that, like in Idaho, right? 350, 400, 420, maybe, like kind of where we're at to start. We're definitely seeing multiple offers. Those homes, go quickly. Um, and so we're have to present stronger offers, but yeah, there's also some price points that are sitting for a while too, right? So
Yeah.
depending on, it's very interesting right now.
Yeah. Well, that's why we recommend that no obligation consultation, because depending on the area of town, so you got micro markets, you've got national or macro markets that you hear on the national news, and you could be inclined to, I hate to say buy into that, but to have that sentiment, and it could be drastically different than our micro market here in the Treasure Valley. And then you can even have nano markets where you're like, wow, that behaves totally different. The pricing and the ability to negotiate and all that. So it really means you've got to kind of figure out where you're at in the buying process and what, how we can help you, because it could be different from person to person.
Yeah, yeah, absolutely. Yeah,
So
and we're seeing that right a lot lately. So some of the price points are, we've talked about this throughout the winter. Some of the price points are, they're still giving seller concessions. We're starting to see that kind of ease up in some of the other areas, right? So
yeah, yeah, yeah. I would say generally speaking, at a high level, it's still a seller's market, and we'll just go into these contributing factors, right? If you're ever wondering what's going on in real estate, you can pretty much go back to supply and demand, right?
yeah,
That's just economics kind of 101. And if you're curious what's happening, find out if there's a lot of inventory. If there is, you're probably going to get a better deal.
yeah,
If the demand, even if there's inventory, but demand is super high, you're probably not getting a good deal. If you've got a lot of inventory and low demand, then it's leaning in your favor. So I would I would always put those two as kind of the main considerations as to whether or not it's in your favor or not, the market.
yeah, yeah. I mean, there's no way around it, right? Like that is the basic, like you said, that's the basic economic, formula, with any product or good. And
Yep.
so that's the first step that you look at, and you can see that now, um, nationally, right? We're still in low supply. Locally, we're still in low supply in some areas. Obviously, that varies depending on, right, price points, which helps determine your absorption rates and absorption. Man, I can't talk today. Absorption rates and days on market, right?
Hmm.
So once you once you identify that kind of tells you how you can approach everything, right? But overall, we're still in a low supply market.
Yeah, and again, nationally, because of the kind of fallout of the mortgage meltdown back in the day, and the lack of appetite for builders to be aggressive in building a lot of homes, because a lot of them either did get burned or got totally destroyed. So you know that's not going to go away anytime soon. I mean, it's getting better, but
Yeah, it is. It's going to be slow, right? So yeah, to your point, back the builders quit building after '08. Like they just stopped. And then they started again, market picked up, they were behind, then we had COVID. They got more behind, right? Not because of what we thought was going to happen, but because of massive increased demand.
yeah, everything got
So,
consumed. Back to
right,
square one, no inventory.
right. And now we're in a market where the builders are behind. And because of COVID's low interest rates, many of those homes in a 2 and 3% interest rate won't hit the market. People either don't want to leave or they're going to turn it into a rental.
Yeah. Yeah, that
So,
contributes to low inventory, because a lot of homes aren't coming on the market, right? For me, you'd have to, pull me out of here on a stretcher, at the interest rate. So we have 50% in our market are new construction homes. So if
yeah.
you're going to go look at a home, that's a high degree of likelihood that you're looking at new inventory. And right now, there's some concessions and some negotiating to be had that makes that helpful. But it gives you an idea of kind of where we're at,
Hmm.
um, and why we would help identify whether you're a candidate for a resale or existing home versus a new construction home, and the differences of the two. And then the other ones I have here, kind of where we're at with war and employment, rates, like that stuff's going to fluctuate. Um, but I think when we boil it all down, it'll come to our ultimate recommendation of, if you can buy, there's a high degree of likelihood that you should, because the values aren't going to drop much more. Back to the inventory conversation, right? It's
Right.
really stabilizing. the values. Yes, we had a correction post COVID because values went up way higher than they should, and they've corrected. So
No bubble burst though, right? Like
correct,
there was a bubble. We just had a slight correction. It's
yeah,
pretty
because of low inventory.
right.
Yeah, yep, yep,
It was just different, right? Like '08, we've talked about this ad nauseum, but '08 was all speculative, right? People buying homes that shouldn't, uh, second homes, investment homes, right? Like all of the above, just because of the loose and lax, guidelines around the types of loans that were being done. And so that just, just a very unique situation. In a normal recessive period, in, inter, home sales typically don't go down; they either flatline or they increase very slightly. Right?
yeah,
That's the trajectory. So, that's what we saw. Right? That
yeah,
they jumped up in COVID, but a lot that was driven by demand.
yeah,
Lack of supply and high demand, and so it wasn't. Yes, prices were inflated, but it was because of the market itself, not because of speculation.
yeah, yeah. And in our market specifically, we do have some national builders coming in. So obviously, we've got more builders at a larger scale coming in. So we're making some progress, but it's not at a clip that's going to catch us up. Certainly not to the topic of the next topic, and that's demand. Right? We
Mhm.
have a lot of people looking online and even getting in homes. Right? Our open houses per day in a 2 or 3 hour window are getting six, seven, eight, so like we call them sets, right? It might be an individual, might be a couple, might be whatever. Um, they're not pulling the trigger just now, but they're certainly looking. Like there's a high degree of interest, and that's going to translate to demand. And we'll get into the projections about that later.
Yeah, yeah. There's definitely a lot of activity out there right now. I'm We talked about this, a month or so ago. I'm seeing, mortgage applications up. It's yeah, we're getting into that spring market, right? That normal Idaho spring market.
Yeah. Yeah. The deeper we get into spring and then early summer, seasonally in our market. So that's another thing to take into consideration. Is seasonally, that's when people start moving, right? Weather's getting nicer, people want to move. Kids got to be in their home for the next school year. Um, anyway, a lot of information that'll translate to projections and recommendations later. But the uncertainty stuff. Obviously, as of last weekend, things really changed, right? The whole Iran thing, came to a head, and we don't know how long that's going to last. Hopefully, it's weeks and not months. But people get fearful.
Yeah, and yeah, Monday morning was not good, right? Like, so we had went through a period, the last couple of weeks where rates had been just trickling down. Then we had a couple of great days, 4 or 5 great days after um, Venezuela, right? After things had settled down, we had some pretty good moves. We were at a spot to where, the bond market was at its highest it's been in like 2.5 years, and um, so rates were looking good, everything's positive, and then the Iran conflict happened over the weekend, and when oil's involved, it typically gets pretty volatile.
Yeah.
So for the bond market, um, typically we'll see betterment during a war.
Mm-hmm.
Um, you know the way that money flows in there for safety and everything. So we usually see quite a bit of we see that get better typically during a war. But when oil's involved, right, we saw oil prices jump over the weekend due to that conflict, and so that really pulled some money out of the bond market, and we saw interest rate with like we lost all of that betterment, right? We
Mm-hmm.
were probably 90 basis points movement in negative movement on Monday and Tuesday, which is a huge move.
Yeah.
And um, but
Well,
it's it, it's
uh,
it really is. I think what people need to realize in this it's volatility, and you and I have talked about this and talked about this and talked about this. Like it's there, we expect interest rates, mortgage rates to get better over time,
mm-hmm.
but that doesn't that there's not going to be volatility, in the middle of that.
Yeah, that's where I was going to go with it is if you look at it on a day-to-day basis, you're going to drive yourself crazy. But if you look at, general trending and what, when we get into forecasting, and it's hard not to jump to that. Um, but, making plans on a day-to-day isn't super helpful. Making plans, for months or years out is more helpful because you can look at the broader picture. Those spikes up or down, you might hit it when it's down. If you're lucky, you usually can't anticipate that. Who'd have thought that all this would go up Monday because of the, Iran conflict? We just don't know. So to give yourself swings, emotional swings based upon fairly short-lived, economic issues, it's just not super helpful. And that kind of goes with unemployment as well, right? Like unemployment comes and goes, ebbs and flows. Um, Generally speaking, I think, nationally unemployment's really low. Inflation is really low. In our market, you've got low unemployment numbers except in certain industries, right? Healthcare is doing well, tech is doing well, the trades are doing well, but there's some other, industries where people kind of struggling.
Yeah, there's industries that are growing and things like that. I think, and this is, this all relates back to, I think, all of these are pieces, right? Like of what's going to happen to mortgage rates.
Mm-hmm.
So we had the volatility with Iran. President came out already and said that he would ensure that that we have the reserves, and so we're already starting to see that stabilize again. We're already starting to see that the bond market to get better again. Unemployment is actually, this is where I'm going to differ, because the numbers that we look at, I think unemployment is way higher than the numbers they're given. Right, every time that they've given the unemployment
Follow
number,
on correction.
a month later or 2 months later, like they make an adjustment, and it's been massive. So the way they're calculating the unemployment is not good. But as unemployment goes up, right, that they're gonna make adjustments, and we're gonna see the bond market get better, which typically mortgage rates will get better, right? Because we're gonna see relief for them as they try to curb that unemployment.
Yeah.
So both of those things, right? Like we had some volatility that's coming back. Unemployment, I think, is higher, and I think in our industry, it's pretty known. I think they're saying like 4.3%, but when you talk about uh, the amount of jobs that are available and things like that, you're looking closer to 8%,
Yeah.
right? And so, for a total number.
Well, and I thought for a while as that the government. Well, I don't know exactly what I thought, but it sure seemed confusing. And when I dig into it, I'm now aware of why it can be difficult to calculate, right? There's extenuating circumstances, you
There's,
know.
there's I think the way that they calculate it is antiquated. This is a personal opinion,
Mm,
but the way they calculate it is antiquated. I mean, just for simple reasons that the job market is not the same as it used to be,
mm-hmm.
right? So
Right.
after COVID, the work from home environment like blew up, and so you could post a job offering in one state, and it could be across 50 states, and it's going to be counted multiple times,
Yeah.
right? And so that just simple things like that is what is making it more difficult to calculate that unemployment number. Um, and I think they just need to make some changes in the way they do it.
Yeah, and I think it's important to go back to specifics, right? For example, if you're in our market in one of the three industries that I just mentioned, for the foreseeable future, there's got to be a lot of employment opportunity, right? People move into this area for healthcare to a large extent because we're small enough to have, the lifestyle that they're looking for, but enough emergency and healthcare services to, you know, be confident that they're going to be well taken care of. The trades, I just can't imagine those are going anywhere anytime soon. So what I'm saying is, you know, don't get into the sway of the conversation at a high level or broadly speaking, look at your specifics. What industry am I in? How confident am I in maybe not my exact job, but the industry itself in the market that I'm in? So, and then the other one was kind of AI, right? Everybody, you and I've had a conversation around AI and how it affects going to affect our industry. I had a conversation around AI. My business partner on the our coaching side, he's a business psychologist, and kind of how all that goes. So everybody's wondering, how is this going to affect, me and my career? So there's uncertainty there. Um, I guess my overarching take would be don't stick your head in the sand, assume it's not gonna, but know that it seems like almost everything takes longer than we thought it initially would, right?
Hmm.
How long we've been talking about a paperless society, how long we've been talking about flying cars, you know what I mean? Like it comes, but it seldom happens as fast as people kind of create anxiety around it, if that makes sense.
Yeah, yeah, absolutely.
So
No, it's yeah. It all boils down to just preparation. Like it really is. I don't whether it's the job, whether it's buying a house, whether it's you know um, a kid playing high school baseball, right? If you're prepared, then you're the one that's going to win when the opportunity comes up, right? So even in
yeah,
volatile markets, there's opportunities that come up, and as long as you're the one that's prepared, there you're gonna be the one that wins.
yeah, yeah, yeah. Well, I think that's a good segue to our recommendations. Let me make sure we didn't miss anything here. Real quick, everybody kind of knows the Fed chair transition's happening, so that creates uncertainty. But I think almost everybody would anticipate that interest rates are likely to trend down. Chase,
I think I really do. I mean, truth be told, nobody knows, right? We don't have a crystal
crystal
ball.
ball.
Crystal ball, yeah. Um, so truth be told, we don't know. From everything, all you can do is look at historic data and current data and try to figure out what's going on. With everything that's in place now, it should continue to trend down, and it has. It's going to have its blips of volatility because the international geopolitical landscape is just not super stable right now.
Yeah,
So the Fed chair change, like a lot of people are seeing that as a positive thing for the real estate market, for the mortgage rates, um, because maybe there'll be more collaboration,
hmm,
which good or bad, right? Like that's a touchy subject. The Fed needs to be independent of the political landscape for sure,
yeah,
but there's some things that they've been really slow to respond to, and I think maybe this change will help that be more on time with what the
gotcha,
economy needs.
gotcha. Yeah,
Um,
decisions made sooner than later.
yeah, and
That's
the affordability piece, like I mean, you and I, we both know it can be hard. There's markets where it's really hard in,
yeah,
um, but the longer, it's funny though, right? Like the longer that you're at that price point, the more people adjust and figure it out, and the market adjusts and the economy adjusts so that people can afford to buy where your market's at.
yeah, yeah. In regards to the affordability, which does transition also into our projections and recommendations, but there's things underway that the administration's been talking about, none of which I've seen materialize, and they're all theoretically about how they'd affect the real estate market. You're talking about, banning investor capital on single family homes. You're talking about a cap on credit card interest rates. You're talking about, reducing regulations. Like all of that is being bantered around, and our 50-year mortgage is being tossed around. All of that to say none of it's sure to happen, but if it does come along to varying degrees, they're going to contribute to positivity, right? This is an issue. This is a focus. These things, or some of these things, and other things will come into play to make the situation better. So I
Yeah.
think it's top of mind for sure.
Yeah, I mean, you've heard you've heard you've heard the president talk about, stopping the, corporations from buying single family homes and things like that. And they did do an executive order to, um, that they're at least looking into that, right? They're making sure that, that the emphasis is on, families, being the buyers of single family homes. Um, but again, it goes to, like, we tell everybody to do their research, and you try to find the best information you can. But they were actually a very small of the percentage homes that were bought last year.
Like 3% or something, 3-5%.
Yeah, so understanding the perception of where the market's at, like you can say we have, an interest rate problem. You can say we have an affordability problem, but what it all boils down to is we have a supply problem. Like that
Hmm.
that is the best fix for where we're at right now.
Yeah, yeah. Build more homes, convince people that it makes sense financially to migrate out of their home. Some of them are like the largest segment of moving properties is the baby boomers, and that's because they've got ton of equity, lots paying cash, lots paying huge chunks of equity down. So, those folks aren't as susceptible to interest rate swings.
Well, when we've talked about this before, it's been a while, but like people seem to forget too that so we got a little bit of a reprieve, right? This generation of buyers right now, we got a little bit of a reprieve because they're about 10 years later buying a home, right? Or 5 to 7 years later and buying a home than what the average had been previously. Like
Yeah,
it's
they're
like 30,
older, 40.
right? Yeah,
Yeah,
32, 34, like mid to late 30s is where they're at right now. So we got a reprieve, but that generation is massive, right? There's more of them than there were baby boomers.
yeah,
And so by a lot. And so adding all of those home buyers to our market, even without everything else that's gone on, we didn't have the supply for that many people, period.
yeah, yeah. Hmm. Well, let's dig into some projections. I think we already touched on the inventory issue. Hey, getting a little better, but there's reasons why it could get worse. But specifically in our market, we've got some builders really rolling on, large builders rolling on strong. Um, Demand, everything indicates that there's pent up demand and it's going to come rolling on, and it typically comes rolling on in the next month or two. Um, the war is, we don't know, but my guess is it'll end sooner than later at the pace that it's clipping along.
And it's short term volatility as to how it affects, interest rates.
Right.
Like that's you know,
Yep. Yeah.
more than likely.
Everybody's anticipate rates going down. So all to say, it seems like the market's going to improve for the sellers, right? As interest rates go down, demand picks up. As inventory gets consumed, there's less homes, so their values pick up. So the projection is it's going to strengthen back into the seller's market a little bit as we get deeper into the spring and early summer. So if you're a buyer and you can afford to buy, so we'll talk about recommendations, but all the projections that we're seeing indicate that now's a good time because it's going to be more of a market for a seller going forward.
Yeah.
Is
Yeah.
that
And
is that your read?
yeah, absolutely. And it's earlier this year, right? Because we didn't really have much of a winter here in Idaho.
Right.
And so, like it's the 1st of March, we're barely out of February, and we're already seeing that pickup happen.
Yeah. Right. Well, the traffic, you see the applications, I see the foot traffic. We were just in February, and it's usually cold enough that people aren't super interested in going and looking at homes. But man, that is not stopping them in the last couple 3 weeks. So the
Mhm.
warmth is already getting people out and about looking. So yes, it's coming on sooner than later. And then of course they're going to want to buy and get through escrow in time to move after the kids are out of school and get in before next year. So I think those are all pretty fair assumptions based upon what we see happening and what we anticipate happening.
Yeah. 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 Absolutely. There will be all of that leads up to a little bit of volatility, but an overall strengthening real estate market.
Yeah, let's talk about some general recommendations, and I think for listeners, you've kind of already heard that, right? Generally speaking, if you're going to buy, um, talk with us, and there's a high degree of likelihood that based upon where we're at and the options that you have, meaning the ability to negotiate. So if you need, help with closing costs, which is can be significant. If you need help buying down a rate, sellers are doing that now, or whatever other concessions that you may need. You may not get them all right now, but you're getting good help right now.
Yeah,
And for
yeah,
some people, that's whether you can buy a home or not, right? If you haven't saved, if you got down but you haven't saved up for closing costs, you absolutely need that help.
yeah,
If you are on the threshold of buying at a certain interest rate and you're not quite there, if the seller can help you buy it down, and now you can either one get in the market or two raise your buying power to get into a different kind of caliber home or a different market, area of the market. Both are super helpful. But
yeah. I mean, there's still so much opportunity here, right? When you talk about seller credits and all that stuff, as I mentioned earlier, I work in a bunch of different states, but we are so blessed here. I'm going to, plug our friends over at Idaho Housing. Um, there are so many programs that they have available to help people get in houses, and their down payment assistance is like no other. Like they are one of the best partners that you can have in getting in your new home. And yeah, like so to Jared's point, you don't have to save up 20%. You don't have to save up 10%. Um, they've got you covered. They will help you get into your home. And so, you know, if you feel like everything else is in place, but you don't have that money, or, like if you want to use your money to get your credit better and then that'll eat up your down payment, like talk to us. They have options.
yeah,
They really are an incredible partner for us here in the industry.
yeah, yeah. We've had episodes of getting in under $1,000 and kind of what that would look like and how to put that all together. So for folks that think you've got to have 20% with closing costs and inspection and appraisal, which we've addressed them in our current promotion. So yeah, don't hesitate to see what it's going to take and see if we can put it together, because of out of any time in the recent future or recent past, we've said this before. Now's the time to get some help to get into a home.
Yeah, yeah, always.
So yeah,
It's always
um,
now or
yeah.
tomorrow.
As far as specifics go, I think we just hit that on our promotion with that no obligation consultation.
Mhm.
Just a conversation, kind of about what you want to achieve, what you're looking to do. Even a quick online app gives Chase a snapshot real quick and can do a soft pull on credit, not to affect your FICO, and very quickly we can say, you know, yes you can or no you can't, but it's never no you can't ever. It's not now. So the sooner we get identify where you're at and what that roadmap's going to look like, the better off you'll be. So
Yeah, yeah. It goes back to what I said earlier, right? Like for as of right now and for the foreseeable future, the market is going to be very headline driven, right?
mhm.
What you read in the news, what you see in all of that, right? And so there, because of that, we are going to see some volatility, some ups and downs, right? If you were investing in the stock market, you would be sitting on the sideline waiting for something to happen, but you would be what? You would be prepared to go, to move your money
Yeah,
when the time came. It's
yeah,
no different than with your home. Things are volatile right now, but if you're prepared, you can win in these situations.
yeah. Love it, love it. I think that's a beautiful way to wrap it up. We're half an hour, 35 minutes, so it's actually on the shorter end of most of our podcasts, but hopefully this one was packed full of helpful information and kind of where we're at, what we anticipate happening, and to some degree some recommendations about next steps. So other than that, we'll wind things down and wish everybody a blessed one. Thanks, Chase.
Yep. Take care.
Take care, everybody.